Good morning, everybody. Hey, welcome to the first day of July, the first day of the third quarter, and hope that you're preparing for a great 4th of July weekend. Yesterday, though, we ended up the second quarter, the first half of the year, not in very good shape. We ended up down. We'll talk about that and more when Scotty joins us here just in a few minutes. Before we do that, though, let's just walk through a couple things. Remember that there's a lot of things in this world that you and I cannot control. But when it comes to our investments and our portfolios, we can control how much risk we have sitting in our portfolios. But we need to know what that risk is. And that's the issue I see every day, is that people don't understand the amount of risk they're really taking within their portfolio. Give us a call at 863-382-0037 to schedule your core retirement portfolio review, where we'll help you make sure that you're on the right path for the retirement you've always dreamed of. And with that, we've got Scotty bring us online here next.
Light FM. I'm a country music guy by nature, but man, that's a good tune. There's The Weekend and Save Your Tears. It's 8:38 now. Phillip's on the line. Let's ride out to Statler Financial Services in Sebring and wrap up the week in finance and investing. How are you, Phillip?
Hey, doing well today, Scotty. It's been good to have you back on the air with us. I know it's in the early morning for you, but hey, it's been a good couple weeks here. And I know Dave will be back in the seat on Monday, hopefully. So good. You get to sleep in a little bit.
There you go. I'm kind of looking forward to it. I have enjoyed our time together, Phillip. I always do. Thank you.
Hey, you know what, Scotty? Today is the first day of July. That's the first day of the second half of the year. And so the third quarter starts today. A lot of things start today. And we don't have much in the way of economic news, obviously, because this is the first day of the third quarter. And it takes a little while for the government to start to hash out some of those numbers and get them to us. So I thought I'd start out this morning just giving us kind of an overview of maybe the first half of the year. I know it's not been pretty. It's not been a great first half of the year. But I think we need to give us some perspective. And I pulled up the S&P 500. And on January 1st, the S&P 500 was somewhere around $4,800. And we closed yesterday on June 30th, the first half of the year, down to $3,785. So down over 1,000 points. And so that just gives you some perspective of what that really kind of looked like. Is that good? Is that bad? I mean, it's bad for those people that are holding stocks, but for those folks that may be in a well-balanced, risk-averse portfolio, they may not be down that much. I mean, that's a significant downturn. But just because I have this conversation with my clients all the time, just because the indexes are down significantly doesn't necessarily mean your portfolio is down significantly. Right? If you've got the right amount of risk in your portfolio, then you may not be down 25% of what the market's down. I mean, you're probably still going to be down. Don't get me wrong, but not like earth-shattering like the markets are down. However, the counter to that is this: if you don't have the right amount of risk for you in your portfolio, then you may be down as much as the markets, and that may be making you feel very uncomfortable. And one reason we need to make sure we've got the right risk matched portfolio for folks. Just this last 6 months gives us an indication why that's important. So just to kind of overview, the S&P 500 did end up down almost 0.9%. Yesterday closed at $3,785. The Dow closed down 0.8%. Down $253, so it closed at 30,775. NASDAQ was down 1.3%, down to $11,028. So everything definitely in the red. But I was looking at other things this morning that really caught my attention, Scotty, and one of them is looking at the gold and silver and the commodities indexes, and we'll talk about those more in a minute, but they're significantly lower than what we've seen. And then I look at the cryptocurrency. Crypto's down significantly from where it was earlier. We've got crypto, Bitcoin down. It started out today down below 19,000. It has crossed back over to 19,255 right now, but that's a substantial decline from its all-time highs in the 60,000 markets. Ethereum, it's down significantly. It's going to open this morning somewhere around 1,050. But I'm drawing this because I've had a couple conversations with clients this week that, you know what, things are different this time. They're different every time though, and that's, I hear that all the time, that it's different. We see a different economy, we see a different market, and that's true. But guess what? It was true back in 2000. It was true back in 2008. And now we see it's true again. Now in 2022, we're seeing a different economy. It doesn't mean that it's bad, doesn't mean it's good. It's just different. And it means that we have to still have a process in place to deliver what we need to be delivering for clients. So, you know, we get all bent out of shape when we see our portfolios going down. And I get that. But if we have the right amount of risk in our portfolio, then it's not so bad for us to ride through these weathered storms.
Sure.
Makes sense. Makes sense, Scotty?
It sure does. Makes a lot of sense. So sure does. I'm really glad there's guys like you that can keep it all straight, because it's amazingly complex. There's so much to consider. Like you say, every downturn is a little bit different. A lot to keep track of. It
is. And, you know, we talked yesterday about or Wednesday maybe, I lose track of days now, but of the GDP number. You know, it came up. It showed that our economy contracted by 1.6% in the first quarter. Now, we don't have the second quarter number yet until the end of July. However, the Fed, and Dave and I talked about this one time, and I didn't really realize this, but it's making the news more and more, is the Federal Reserve in Atlanta has what they call a key real-time model. And back a couple weeks ago, it showed basically no gain, no loss. However, the new reading says that the economy is contracting another 1% in the second quarter. Now,
right.
By definition, if that is true, which it's kind of feeling that right now, that's a recession. Yeah. We have technically crossed that line. And we're seeing more and more talking heads, more and more economists, money managers come out and say, yes, you know, we don't have the numerical proof yet, but we are in a recession. You know, I hate to tell people that, but it is what it is, right? And we just have to work our way through it. The Fed came out yesterday and said, well, you know what, we may be raising interest rates too fast, but the alternative is worse. So they're basically saying it's better for us to throw you into a recession so that we can get inflation below where we need it to be, as opposed to letting inflation run rapid and lightening the fall. So that was basically Powell's speech on Wednesday.
Right.
So no, I've talked a lot about different things. It's because it is the first day of this third quarter, and there's not a lot in the way of economic news. We did have one company report, and that was Micron Technology. You know, they're a chip maker. They had better than expected quarterly profits. They're coming under pressure though, because of their lower than expected sales outlook for this next quarter. You know, weakening demand. They're seeing weakening demand come out. So Micron Technology is trading down about 4.8% this morning. Another company that we've been talking about, Dave and I have been talking about a little bit over the last probably month or so, and that's Kohl's. Kohl's have been in talk with the franchise group, which is the parent company of the Vitamin Group, the Vitamin Co. store. And they had, however, they announced this morning or yesterday that they broke off talks, and that the franchise group has decided, because of economic conditions and retail uncertainty, that they are no longer interested in Kohl's. So Coles is down this morning on that news, almost 19%, Scotty. A big drop for them.
Yeah. Okay.
Yeah.
All right.
It'll be a new 52-week low for them. So, in the whole scheme of things, that's pretty much all the news to really talk about this morning. I know there's not a lot of stuff out there because, again, it is the first day of the third quarter. And so we can just kind of talk about how are we going to start the day. That's
okay.
How are we going to start this first day of the third quarter. And Scotty, it is still red. I will say it has improved in the last 30 minutes from what it was earlier this morning, but it is still red. We got the Dow right now down a little less than 0.2%. The S&P 500 down a little less than 0.2%. NASDAQ 100 is down about 1/3%. Russell 2000, the small cap index, is down about a little over 0.5% right now. So it looks like that we are going to have a red opening as we get ready to start the day. It could bounce, you never know, but that's what it's looking like, trending like right now. I mentioned a little earlier, silver and gold taking a big hit, not reacting and acting the way we would expect them to react in a downward moving market.
Right.
We would expect.
I was going to ask you about that, Phil. I mean, isn't that? Gold and silver, isn't that where people go when they start to worry about other equities and whatnot?
You would think so, right? I mean, that is the general consensus. That's one of the conversations I had with a client this week. Is that gold and silver is just not acting the way it normally would act and the way you would expect it to act. Because you're right, as the market has declined, you would expect gold and silver to be moving up substantially, and it's done the exact opposite. As a matter of fact, right now, silver is down 5% this morning. It's going to open at $19.30 an ounce.
Below $20. Yeah.
Below $20. And just a month or two ago, it was bumping its head on $23 an ounce. So a big disparity there. We've got gold down 1.1 1.25 right now, down below 1,800 to $1,785 an ounce. I can't remember the last time we were below 1,800. Right. So again, moving the wrong direction. We do have crude oil. It's got to be doing the wrong thing. It's heading up today, 2.5%.
Of course. Yep. All right.
It's at 108.39 a barrel right now, which is down from the 113 we saw earlier in the week. But still not where we want it to be. We'd like it down below 100 again. But so that's kind of where we are this morning, Scotty. It's going to be a Friday, and who knows how we're going to end up the week. But hopefully we end up with some green. Maybe something will cause somebody to start buying in there. Nobody knows until the end of the day. But that's where we are.
All right.
So, but Scotty, that's one of the reasons that I developed the core retirement design, is to help people really and truly make sure that the amount of risk they have in their portfolio matches up with the amount of risk they can handle in times like this. They can give us a call at 863-382-0037 to schedule their core retirement design phone consultation. There's no charge for that. And we'll make sure that they're on the right track for the retirement they always dreamed of. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk 730, 95.3 FM.
All right, Phillip. Well, thank you so much once again. Thanks for carrying the ball last couple of weeks. We really appreciate that, and all the best to your family. Have a happy 4th of July, my friend.
All right, guys, everybody, you have a healthy and safe 4th of July weekend, and Dave will be back with you guys on Monday.
You bet. All right, take care, Phil. Good talking to you.
Bye-bye.
Statler Financial Services, call 382-0037.
Hey, folks, again, I want to thank you for joining us today. I hope you guys have a safe 4th of July weekend. Until next week, take care.